Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Stocks struggle for direction following a global sell-off that saw cryptocurrencies lead declines in global risk assets. A closely watched auction of 10-year Japanese government debt drew strong demand. Ukraine's President Zelensky says the new draft peace plan looks better, while the EU expresses concern over US attempts to force through a deal. Trump administration envoy Steve Witkoff meets Vladimir Putin in Moscow today. And we will shortly bring you details of the Bank of England's banking sector stress tests and its financial stability report. We'll be closely watching gilts and UK banks at the open.
Good morning. Let's talk about where we are with markets and what is happening here. The picture at the moment is stability. That is the narrative that you are watching after quite a lot of turbulence yesterday. Was it down to the Japanese? There's multiple reasons maybe for what we saw yesterday. S&P futures not bouncing, absolutely flat. Bitcoin had a look at 84, has bounced to 87, but this time yesterday we were in sharp decline and we have not filled that gap from yesterday yet. So Bitcoin trading at 87. Japanese 10-year, and I was mentioning it, we saw signs of stability there, decent auction on the 10-year. The market's beginning to look, it seems, actually beyond the rate hike that we are now anticipating and trying to think about how big the gap could be to the next rate hike, and that I think is obviously moving the yen as well. But signs of stability certainly within the Japanese 10-year, which caused so much turbulence yesterday. We've got a lot to discuss. The countdown to the opening trade starts right now. Tuesday morning, how are you doing? Lots going on, lots to think about. Big day yesterday for the bond market. What's going to happen today, I think, is an open question. You've got a lot going on. Let's start with the Bank of England. Its stability report is out. Its financial stability report is out. In some ways, Anna, this is more important for the UK banking sector than what we saw in the budgets and what we saw there with levies. This is a big deal for UK banks.
This is a big deal. The team is just getting a chance to go through it right now, it seems, and we're not getting a huge amount of detail yet, but it doesn't seem as if it's giving the banks what they maybe would have wanted. So the Bank of England maintaining their counter-cyclical capital buffer at 2%. Now, we'll wait for other details. This is a big report. There'll be all sorts of other things in there. Maybe there's something else that plays to the bank's strengths. But if we remember that the capital buffer is a cushion against the bad times, there had been some hope perhaps within the banking sector that maybe this counter-cyclical buffer would be reduced, and that would require the banks to hold back less capital and therefore able to either return more to investors or to lend more into the real economy. Yeah, or particularly to mortgages, which is where maybe some concerns lie at the moment in terms of that kind of fixed amount of stock. Would they be lending into an economy that is trying to push for growth at the moment? I don't know. That certainly doesn't appear to be the message. The UK biggest lenders have passed the bank's stress test. I don't think that was ever really a cause for concern. But the bank is pointing to material uncertainty in the economic outlook. It sees that persisting. It's saying that global risks remain elevated. In some ways, you can understand with that kind of narrative why they wouldn't want to de-risk the banks. Absolutely, and we'll wait for more details about the risks they're talking about here, because last time around, this was 6 months ago, because we hear from them every 6 months on this particular report, they were talking about hedge funds, the role that hedge funds play in gilt markets. That's sort of domestic, but also takes in the broader international hedge fund community. But they had other concerns around private credit. That's clearly a global story. They were concerned about AI and valuations in AI, whether that's going to be... In other reports, they've certainly mentioned that. Interestingly, we heard from the Fed yesterday, and they were talking about risks in the commercial real estate space and keeping an eye on the banks with that in mind. So there are all kinds of global risks, I suppose, to look at if that's what you're minded to do.
They're also talking about the fact that they are going to probe the private markets and the resilience of basically the private credit market in a stress test. Now, the bank doesn't have direct line of sight, A, as to what is happening, and B, kind of from a regulatory point of view, any kind of direct line of sight on this sector, but it clearly sees a risk emerging within this space, and it's asking for voluntary participation within this stress test. And it looks like the largest firms are signing up, so it'll be fascinating to see what ultimately comes out of that. But are the bigger firms where the risk lies? Is it potentially some of the smaller firms that have maybe pushed themselves too hard as to where the real problem could emerge?
Yes, exactly. What will that cooperation by the sector, by the private credit sector, look like? What will we learn from that? So that's what the Bank of England is concerned about right now. Let's think about markets and what we saw the markets concerned concerned about yesterday. Now, was it, Guy, something pushed up yields globally? Was it the Japanese conversation?
Most people are pointing their finger at the Japanese.
Was it the crypto conversation? There was a bit of that and risk off associated with that, but that doesn't necessarily explain it. Was it inflation concerns at the longer end of the curve? There were all these kinds of narratives floating around yesterday.
I think most people have drawn the conclusion that it probably was, and this is always the nice kind of game of pin the narrative on the tail of whatever kind of the tail narrative on whatever the reality was. Most people are pointing the finger at the Bank of Japan. I don't know is the honest answer, but it does seem as if that was where the risk lay. But you did see a big move in US 10 years, which had no logic to it in terms of the reality of kind of anything changing materially. Yes,
there was something else that was flagged as a possible tail for that donkey, and that was corporate issuance. So if corporates are issuing a lot, maybe that acts as a competition for those looking for fixed income exposure.
Did you see the data, though? The data's all pretty bleak in terms of what we got out of the United States yesterday. Certainly the ISM stuff, the bulk of the data is quite negative. So you would assume that the market would price lower rates, not higher rates. And this is going to be the real conundrum that we're going to face, I think, is the fact that Trump clearly wants lower rates. He might get them at the front end with HACCP, but is he going to get them at the back end? Is he going to get them at the 30-year tenor, which obviously a lot of mortgages are fixed at? You could end up with a cheaper car loan, but a more expensive mortgage, or mortgages not moving very much. And you wonder actually what people really want. Do they actually want cheaper mortgages?
Yes, you can't live in your car, not comfortably. Let's talk about crypto, because crypto was certainly an area that we had quite a lot of activity in. And just a nod to it, because it's looking a lot calmer today. But we did see a big sell-off yesterday, and I've seen two different takes. Some on the Markets Live blog saying this morning, look, this is different to other sell-offs we've seen before. This is all about institutional and ETF flows, and those are getting nervous, and that's a bad sign for crypto. And others saying this isn't that different. Institutional adoption is increasing, interest rates are falling, there's room for retail investor appetite to grow. So still two takes on where we go on that one.
The take this morning is a little bit of stability, but not much. Big gap yesterday, has not yet been filled. How much further do we have to go before actually, particularly the kind of the Michael Saylor end of the spectrum, starts to see a real problem? And what happens there with forced selling in terms of these crypto hoarders could become more self-fulfilling. But everybody seems to be hanging their hat on the idea that maybe just rate cuts are going to save all of these assets, that risky assets are going to do well next year because the Fed's going to be cutting rates aggressively. That feels like a consensus narrative.
Let's briefly mention Ukraine, because it's certainly still on our agenda, and rightly so. And then we'll just circle back to the Bank of England, because there's something more to mention there. But in terms of Ukraine, we should point out that, of course, Steve Witkoff is going to be going to Moscow today. He's there already. He's meeting with President Putin, I should say, today. We've had President Zelensky speaking more favourably about the plan that is on the table, saying it is better. Still territorial concessions are the issue. The rest of the Europeans, though, whether it's Emmanuel Macron or Kaja Kallas, a little bit more sceptical about what this means for Europe right now and whether this is something that Europe can be OK with. But we'll see where that goes.
Progress is being made. Great. But then you get the deal is not a deal until it's a done deal. And you've got this huge issue of territory that needs to be resolved. And I haven't seen anything yet that suggests that we are any closer to resolving that issue. And I think that remains the significant problem. We're going to see volatility, therefore, I think, in assets. It's interesting. Skylar was writing a really nice piece yesterday on the M Live talking about Central and Eastern European currencies. Maybe you look there for the reaction and trying to kind of gauge how the market is seeing this story. Is it in defence stocks? I don't know. But at the moment, nobody's clearly got a line of sight. The mood music is getting better, which in theory should be worse for defence stocks and better for some of these Central and Eastern European currencies. But it feels very unconvincing.
Let's just go back to the Bank of England story, because we started this conversation saying, well, they haven't got what they wanted if they were looking for a reduction in the counter-cyclical capital buffer. So if that's what they wanted, they didn't get that. But actually, maybe what they were looking for was a reduction in the CET1 requirement. So this is another measure of the solidity and the big measure of solidity of your balance sheet. And the benchmark CET1 requirement has been reduced by 1 percentage point. So it's come down, and that is perhaps going to be something that does please the banks. They are also going back to this theme they talked about 6 months ago around hedge funds, saying gilt repo borrowing nears a record £100 billion.
So that was, I think, what the market was anticipating in terms of what we were going to see coming out of this, because that brings us more in line with maybe international standards when it comes to the CET1 ratio. But you raised the right point earlier, which is, does this mean higher dividends from the banks, which have been that's been the big driver of performance so far this year, or will it mean more lending into a mortgage market, which has a kind of a fixed pool, you could argue, and therefore is going to drive potentially prices higher and therefore comes with some risk to it? Or do they invest in a more productive economy? Now, I would suggest probably 1 and 2 is probably a more likely outcome than 3.
And we think we have a press conference associated with this a little bit later on. We'll see what the Bank of England's view is. We'll see what the banks, over our conversations still to come, what they intend to do with that money.
What are we going to be talking about when it comes to the bond market? Well, we're going to find out next. Camilla Astabaroga, EFG Asset Management Senior Portfolio Manager, is going to be joining us. We're going to talk about what is happening in terms of the relationship between DM and EM bonds. Mark Weifeld, ARC Robotics CEO, is going to be joining us. Big contracts coming out of the German government at the moment, and they are involved in a huge one in terms of the AI story relating to the Eastern Defence Strategy of the German Army and Armed Forces. Sharon Bell, Goldman Sachs Senior European Equity Strategist, joining us at 8. And Gustavo Menderes, Ashmore Group Research Head, out with their 2026 outlook. What are we going to be seeing? We're going to find out later. Yes,
we will. Let us talk about what is on the agenda for today. In terms of the macro calendar, we have a few data points to mention. 10 a.m. UK time, Euro area November CPI. We have we thought we'd have the OBR chair, Richard Hughes, and other OBR executives giving evidence to the Treasury Committee. I don't think he is expected to attend anymore, as he has resigned. But we will have an appearance by some members of the OBR to try and establish what exactly went on during the budget. Then, a little bit later on, we get an OECD economic outlook. And as we've mentioned, Witkoff, Trump's envoy, is going to be meeting with President Putin in Moscow. And the Fed's Michelle Bowman will be testifying later on.
But not saying anything about monetary policy, because she's not allowed to, because they're in the quiet period.
OK. And in terms of the Eurozone focus, steady at 2.1% is the expectation around inflation.
We'll look forward to that data a little bit later on, and we'll bring it straight to you as it drops onto the Bloomberg terminal. What else do you need to know this Tuesday morning? The bidding process to acquire Warner Brothers Discovery is nearing a conclusion. Bloomberg has learnt that Netflix worked over the long weekend on an improved offer, which is now largely in the form of cash backed by bridge loans. The competing offer from Paramount is backed by Larry Ellison's family, Apollo, and Middle Eastern funds. Sources say the second-round offers, which are binding, means that the board can sign off on a deal quickly if its goals are met. Warner Brothers, the parent company of HBO, CNN, and its namesake film studio, officially put itself up for sale in October after receiving multiple unsolicited offers for all or part of the company. The European Union plans to commit at least €3 billion over the next year to help sever its dependence on Chinese raw materials, which are critical to the development of technology and military equipment. The pledges are part of a broader plan, which will also create a European Critical Raw Materials Centre to oversee and guide investments, as well as help build stockpiles and coordinate joint purchases. And Samsung has unveiled its first so-called Trifold smartphone, several months before Apple is expected to announce its folding iPhone. We think that's going to happen at the beginning of next year. The Galaxy Z Trifold, which is appropriately named, has 2 hinges, allowing it to transform itself into a larger tablet-sized device. It launches in South Korea on December the 12th with a price tag of about $2,500. The Trifold will then be sold in the United States, in China, in Taiwan, in Singapore, and in the UAE. This appears entirely logical. You look at the pictures, it's very fragile. And apparently if you try and fold it the wrong way, it buzzes and squeaks at you to let you know that you're doing it wrong.
I mean, anyone who's ever wrestled with a map will know that it's possible to attempt. I
hadn't actually thought about that, kind of
folding it the wrong way.
Yes. It's exactly the right way.
Yeah.
The right way of thinking about it. I don't know, this seems logical. Do I want one of these? I don't know. Do I want a separate tablet? I don't know. But it basically becomes quite a large tablet. And it feels quite logical. I'm waiting for them to sort of roll up, though.
Yes,
that would be so.
That
kind
would
of pull
be an
it out.
improvement. That would be like
but
a scroll.
No hinges. We're going back to scrolls.
We're going very medieval because that's like a scroll. And this made me think of a triptych, in art, where you have 3 pieces of art, sort of, speaking to each other.
And you can have separate apps running on all 3 screens. So you can. I don't know why you would want that, but apparently
it's a mini version of my desk setup, then.
That's exactly right.
Yeah, there we go. We found all kinds of uses for it. Right, coming up on the programme, 7:14 here in London. Coming up on the programme, Airbus shares fell yesterday, the most since April, after the plane maker revealed that inspections are needed for hundreds of its best-selling A320 jets. Plus, China's DeepSeek unveils 2 new versions of an experimental AI model that it released 2 weeks ago. We'll bring you a Bloomberg Intelligence deep dive on China's AI ambitions. Rob Lee joins us with an extensive report he's been been working on for some time on China and its what it can do on the AI space. Up next, we dive into fixed income and broader markets following the global bond sell-off with Camilla Astaburuaga, Senior Portfolio Manager at EFG Asset Management. Please get involved in these conversations. IB plus BBTV Go is the function to use. Guy and I love speaking to each other, but we like to hear from you as well. This is Bloomberg.
41 minutes to the start of equity trading here in Europe. It's a muted picture that we are seeing. Not a lot of volatility. This feels more like December than maybe yesterday did. Yesterday was a fascinating session. A surge in corporate bond sales. We've got a global sell-off in govies as well. Maybe shifting around expectations around what we're going to see with the Fed. Maybe you've also got this Japanese story playing into the narrative as well. Hard to get a handle on it. Or is it simply that nobody's at their desks, that volume is low, and as a result of which we're maybe over-interpreting what we're seeing on our screens in front of us? Camilla Astaburuaga, Senior Portfolio Manager at EFG Asset Management, joining us around the table. Good morning.
Good morning. Thanks, Guy.
What does the market look like to you right now? Just in terms of, are we over-interpreting? We've got very small moves, potentially becoming very big moves. And is that just because there's a lack of liquidity? What is going on?
Yeah, I think that it has been an overall good year. And people are less willing to take risk on at this time, especially when valuations are, relatively tight. There's less conviction. Fat tail risks are becoming more, or you are seeing more cracks in the market. All these private credit headlines. We can talk about that if you want. So I think that we should look at volume more than just impact sometimes to see if it's actually something real or just people covering shorts or putting some positions by the end of the year.
So what happens next? Are we sitting tight until the end of the year? How important is the Fed meeting going to be? What are you watching for us to take us through to 2026?
Yeah, no, it has been interesting because all these weeks have been what was 2025, what was the surprises that we had in the market, what are we expecting for 2026. So the main theme has been the end of U.S. exceptionalism. Is that going to continue throughout 2026? And I do think so. I mean, for us, especially as agnostic investors that we don't follow benchmark, has always been this premium that U.S. bonds trade at. We usually don't believe it. I mean, if you look, for example, at all the U.S. telecom bonds versus telecom in Japan or Australia or Europe, there was always that premium. We're like, that's not supposed to be there. It's not that it has better fundamentals. For the same risk, you were getting worse spreads. So I think that it was overdue, that there was this correction. And even in emerging markets, I believe that this is going to continue happening. I mean, we saw China issuing at similar to U.S. Treasuries, and the bonds actually trading inside U.S. Treasuries. Yeah. And I think that there is technicals, there is supply versus demand things going on, but it's also fundamentals. Okay. And fundamentals are telling you that, some of these EM or non-US, credits or governments do have better fundamentals or outlooks than the US at the moment.
Okay, so you think that the conversation around the end of US exceptionalism continues?
I think so, yes.
And that means that US corporates are going to have to pay more to borrow, does it? What else does it mean, Camilla?
Yeah, and especially also treasuries, this risk-free asset that we all believe in, and I think it's still a massive part of the market. Of course, it's around 70 to 80% of the market, but people are rethinking about what investments or total return should be given the outlook of that, and not just taking it for given.
Yeah. So is it that, or is it just that the inflation expectations are a bit sticky, and so it's that rather than some sort of doubts about whether the US will really pay back its debts?
Oh yeah, it's not about whether it will pay. I think that it's still a big. It's not about a default story or anything. It's just like how much you're willing to, given supply and demand or technicals, how much are you willing to give that, and also diversification. A lot of people are talking about that as well, and domestic inflows as well. So, for example, if you're a Chinese domestic or in the GCC a domestic, do you want to have more treasuries? Are you willing to lend more to your corporate or your sovereign in US dollars? So all these thematics are happening, and I think they will continue to happen in 2026 and are interesting. And of course, the other thematic that is happening everywhere is these bigger fat tail risks that are starting to see in the market. So private equity is one that actually I'm concerned, and I think that it also fits with AI.
Why are you concerned about private equity? Is it private equity or private credit?
Well, private credit. Sorry. Too early in the morning for me.
Fair enough, I totally understand.
Sorry, private credit, yes.
Why are you concerned?
I think that I always get a bit nervous when there's no mark-to-market, and
but that's been
no
the case
volatility.
For a while.
I know,
that's by design.
You are seeing
it?
Exactly, but you're seeing these huge inflows and lending from the banks to private credit, and it's like almost like you lend to someone, then it's just an over leverage of that, and now when you're starting to see the cracks, maybe there is a smoke.
Is that what connects us back? So if you were to see a problem in private credit, how quickly does it feed back into the banking sector?
That's interesting, because that's the whole point, and there's not a lot of. It's almost black box. Like you don't see it very well.
Which is why the Bank of England is so worried.
Exactly, and that's exactly the point. Because on one side you can say, okay, these lower credits have been, the private credit has lent to them, so the public credit is better, is in a healthier way. So maybe there's not going to be. But then a lot of the banks actually lend to private credit as well, not to the companies itself maybe, but they are leveraged on that through CLOs, etc. So it's like how leveraged is the whole market is what I think that people are starting to really dig deeper and look into it.
Camilla, are there ways that we can understand, to Guy's point about how that then infects other markets, are there ways, that examples in history or other geographies that we can look at, areas where the lending market maybe lacks transparency, that can teach us something about how these things blow up and how they get resolved? I mean,
that's the biggest question. It's like, what is going to be first? What is going to be the weakest link within the whole market? And I mean, as I said, it's like if you see smoke, is there fire or not? And some things they turn around quite easily.
You see smoke. You see smoke at the moment.
I do see smoke at the moment.
You mentioned AI.
Yeah.
Again, the Bank of England kind of referencing some of this concern as well recently. What is the concern around AI?
So it's all these, before nobody was so concerned about growing and CapEx because it was funded with cash flow. But now that it's funded with debt, people are, is it too much? Is the CapEx too high? Is it going to be profitable enough to return to investors? So I don't think the adoption is the problem. Everybody knows that AI is the future. I'm not contending that. It's just like to the pace that everybody is expecting. And how will that, what's the cost of that debt and the profitable...
So you're not convinced by those who say, look, these businesses are profitable, so we don't need to worry?
And most likely they will be, but the question starts to happen because it's feeding to the rest of the market. So utilities are investing on that. It's like when autos and auto parts, they told auto parts to invest in this EV, and then the demand didn't happen, and then these guys were in a really bad situation because they had invested all this capex into this. So is it a similar comparison into AI? And again, a lot, around 40% of private credit is also feeding through AI as well, or has a link to AI. So again, it's a chicken or the egg problem.
These two universes, they certainly do overlap, don't they? Exactly. The AI universe and private markets. Camilla, thank you very much. Thank you so much for joining us. Camilla Astaburuaga, Senior Portfolio Manager at EFG Asset Management. Coming up, we've talked quite a bit about Ukraine and the defence sector this morning already. We'll continue to do that. Monitoring NATO's eastern borders is in focus. ARC's Robotics is in the running to develop an AI platform to do just that for Germany. We'll talk to the CEO, Mark Weitfeld, who joins us next. This is Bloomberg. Welcome back. This is the opening trade. 30 minutes then until we get the opening cash equity trading for Europe. And the futures picture looks a little uninspiring. Pretty flat, actually. Mixed. Euro Stoxx 50 could be a little bit higher today. Yesterday was dominated by thoughts of crypto, thoughts of higher rates in Japan and what that was doing to risk appetite. But at the same time, we saw commodities going higher. It was a strange one. But the picture for futures looks a little more stable this morning. US futures look pretty flat, Guy. But the bond market conversation yesterday was on the move, and the higher yields were in evidence.
Yesterday, it completely caught me by surprise. Like December, you normally get into December and you start rolling off. Hedge funds are closing their books, volatility comes down. It was interesting listening to Camilla talking about the fact that actually volume's quite light at the moment, and maybe that is the cause of some of the volatility that we are seeing. But you saw it yesterday in bond markets. It was epic in certain cases. This morning, we're quite quiet. We're back to a more normal picture. Germany, France and Italy, as you can see, not much movement in the 10 years this morning. Yesterday, big movement in the Japanese 10-year, big movement in US 10s. Not a lot of the Japanese one I think is more logical, but not a lot of reason for the US 10s to move in the way that they did yesterday. Anyway, that takes us on to what is happening in Europe, which I think does have a connection in terms of its bond market with our next story. The Ukrainian President Volodymyr Zelensky says a new version of the peace plan now looks a little bit better, but he is warning that the issue of territory remains the most difficult to deal with in these talks. Zelensky spoke after a meeting with the French President Emmanuel Macron in Paris.
And on the topic of security guarantees, we have concrete details from the U.S., concrete details from Europe. I'd say these are the three main topics, tracks, but also triggers. We need to be very careful here. I thank our negotiation teams. The plan looks better.
So from France to Ireland, the Ukrainian president is due to make a historic visit to the Emerald Isle a little bit later on. This is something that we want to pay attention to, considering the kind of two extremes, you can argue, of the European security theatre. Bloomberg's Jennifer Duggan joins us now from Dublin. What are we going to see today?
Today, President Zelensky arrived in Dublin last night, and today he will meet with Prime Minister Micheál Martin, and he will give an address to the Parliament here in Ireland. He'll also meet with our President, and there will be also a meeting with the Ukrainian-Irish Trade Forum later on today.
And Jennifer, what kind of support can Ireland offer Ukraine? The Constitution has in the past stood in the way of some kinds of support. So what's on the cards?
Yeah, that's correct. Ireland is a neutral country, so it won't be giving military support to Ukraine. However, there is a proposal before Cabinet this morning to approve 100 million of non-lethal support for Ukraine, and also additional funding to help with energy, building up its energy resources again. So those two will pass Cabinet this morning. Ireland also hosts 100,000 Ukrainians since the start of the war, and there's a lot of support for the Ukrainians who've arrived here, and they've really integrated into the country here. There's a lot of support for them around the country. They live in towns and villages right around the country. I mean, Ireland is very vocal in its support for Ukraine, and yeah, like there's also a proposal before Cabinet today that will look at Ireland supporting the commission that's looking at the reparations for Ukraine too.
Jennifer, thank you very much. Bloomberg's Jennifer Duggan joining us there from our bureau in Dublin as President Zelensky continues to try and drum up support around Europe for his stance on the US-Russia proposed peace plan. Let's talk about the European defence sector. Meanwhile, Germany is set to approve 2.9 billion euros of military procurement contracts this week as part of the country's defence push. One of the contracts is for the development of an AI platform to monitor NATO's eastern borders. The German defence startup Helsing and ARX Robotics are amongst the contenders to win the contract. Mark Wietfeld is the CEO of ARX Robotics, and he joins us now. Mark, thank you very much for joining us. So you have been awarded a contract that allows you to start work on this, and you'll see whether you win the final contract in the end. Tell us a little bit about what it is you're going to be working on the eastern border for NATO.
So, of course, the eastern border is a very strategic region for Germany and for whole Europe. We need to build deterrence. This is the only way how we are aware that this is the only way to avoid a war against Russia or other aggressors. So, of course, we are looking for a way now in Germany and Europe to overwatch the border and to have a kind of alert system and to be ready and capable to fight against an enemy at the very borders of the NATO and Europe. And this requires new technologies. This is nothing you can only do with the analog current platforms like tanks. Of course, we need them, but AI and software is a game changer to multiply our capabilities for our armed forces.
Yes, and Mark, tell us how it is that you are embracing AI to better patrol that eastern flank.
AI is used for the multiplier effect, means that we are turning, for example, analog systems like a vehicle into a software-defined system. This is something we do through our MIFRA OS the operating system, which uses AI to connect systems like drones together with other warfare assets like tanks, vehicles, traditional platforms. And autonomy is the next step. So you need to enable a soldier to maintain not only one system, but several systems, 5, 10x, to multiply its or his capabilities with unmanned systems and to get the distance. Of course, we are outnumbered by our enemies in personnel and material. Means we need distance, we need to safety for our soldiers, and we need this multiplier effect.
Yeah.
And mass production of unmanned systems is the only way to get these capabilities into the warfighters' hands.
Mark, is there a danger that the technology gets too far ahead of the warfighter? How integrated are the soldier right now and the technology? I'm seeing a lot of tests being done in Europe, a lot of exercises being done in Europe. And Europe is struggling to kind of make that connection, get that interface right between the soldier and the technology. How close, where do you think the challenges are going to lie, and how good do you think that interface is right now?
So the pace of technology was for our armed forces kind of overwhelming because it's faster than our processes to implement new technologies into our armed forces. The armed forces are a huge, complex system. So there are a lot of strings attached if you want to implement new technologies, because you need to change a lot from training to maintenance. So there's a big space you need to control and to maintain if you want to change something. But we understood now that change and innovation is the only chance to develop an advantage for our armed forces. And we are pretty fast now, so Europe is aware that we need this. But of course, Ukraine is something we learn from. We can't fight a war in Europe like Ukraine needs to do it right now. But we learned a lot, and there is a transfer of knowledge, there's a transfer of CONOPS, and we try to implement it due to different program of records already launched in Europe.
Where does the bottleneck lie on the battlefield right now? I'm hearing a lot about the fact that it's actually batteries and simply being able to maintain the power to a lot of the devices that are being used, a lot of the drones that are being used, a lot of the independent vehicles that are being used. Where do you see the bottlenecks that Europe now needs to resolve? It doesn't feel like it's in software. Software is something that Europe still has quite strong technology within. But where do you see the bottlenecks on the battlefield?
It's interconnection, so the interconnection of different systems from different centuries. It's pretty hard with new assets of warfare like unmanned systems, drones, to connect them to a tank which was built in the 70s or 80s. So to harmonize our data and our informations on the battlefield and to deliver them as fast as possible, faster than the enemy to our soldiers, this is the biggest problem or challenge right now. The most important thing is to build a mass, so to connect innovation, like unmanned systems, AI, software-defined systems, one-way effectors, so the new assets of warfare, with our industrial base in Germany, because in Germany defense is not a part of this industrial base. We have 100,000 employees, and you cannot arm Europe with 100,000 employees. Means we need to activate our industrial base in automotive, for example, where we have few million employees, where we have automated plants, serial production. This is nothing you can do with tanks. but we need to come to a mass of systems of 10,000 and 100,000. And companies like ARX and Helsing, they can connect these German and European industrial base with military innovation. So they can build a bridge between the front lines in Ukraine and our serial production in automotive in Germany.
And Mark, who is it that is leading this defence capability build-up? Is it Europe? Is it NATO? Is it very much Germany? Who is pushing this forward right now?
I think this is and must be the same. This is a common task. Europe and Germany is very aligned, so we consider ourselves as an upcoming military leader for Europe. And of course, we are absolutely aligned with NATO and its efforts. So it is a common effort, and I would involve Ukraine, of course, too. We can only protect Europe together. So there is no tension or difference between these institutions.
In terms of what would happen if we were to see a peace deal in Europe, in Ukraine, would that change the nature of the debates, not the debates, the process that is unfolding in Germany, in Europe, in NATO? Were we to see a stabilisation of the front line, what would happen next? How do you see the next 5 years if we were to see a peace deal in Ukraine?
Depends. So my opinion is this depends on how this peace deal looks like. It's very concerning if Russia would be successful with this attack, and means Europe understood, and we didn't push the snooze button as we did in the past again. We understood that we need to build deterrence, we need to build capabilities to defend ourselves, and we understood that it's on us if we will see a war in Europe in the next years or centuries. It's on us because, I was 14 years a military officer in infantry. And what I learned in officer school is that defense is to steal, to stop the attacker's desire to attack. And this is what Europe understood, and this is what we are building together now.
Can I just one final point, which I'd like to come back to, which is a moment ago you mentioned the auto sector. Should we consider the German auto sector to be part of the military complex?
We must, because, economic growth and defense is something you need to build together, you need to achieve together, to do it sustainably and to do it at scale. As I said, our industrial muscles in especially Germany, but Europe, are not in defense yet, but in automotive. And new technologies like our robots, and we already implemented or we already adapted production lines of, for example, engine producers to produce our systems at scale. And this is the only way how we can come to a scale of 100,000 systems for the east flank by activating these industrial resources we already have.
It's the industrial base that often wins these conflicts. Mark, really fascinating conversation. Thank you very much indeed for joining us and sharing some of your thoughts with us. Mark Wiedfeld, the CEO of ARX Robotics. For more on the European defence story, don't miss our exclusive interviews, which are coming up in the latter part of this week. We've got the CEOs of Hensoldt and Rheinmetall joining us this week, Anna.
Now, Airbus does defence, but it also does civil aviation, and it's that latter side that's been in focus of late. We check in on Airbus for a second day after the airliner revealed a new quality issue on some fuselage panels. More on what the latest concern could do to share prices at the open. That's next. This is Bloomberg.
Twelve minutes to the market open here in Europe. It feels more like December now. That's a very quiet start to the session here in Europe. Yesterday, though, was epic. So many things going on. Did it start with the Japanese? Was there a relationship between the Japanese and Bitcoin? Was the Bitcoin story related back to what was happening with strategy and what they're doing in terms of their dividend outlook? Lots going on. I don't know the answer. I don't expect anybody does. We're also dealing with light volume at the moment. So let's try and figure out where we go from here. Joining us now, Markets Live Executive Editor Mark Cudmore. Mark, let's start with crypto. is the volatility over, at least for now? And B, please share your thoughts on crypto treasury companies with us.
They're very related answers, Guy. Good morning. I don't think the pain is over for crypto overall. I do think it's really, really important that MicroStrategy came out yesterday afternoon and said that they have a reserve fund to pay. I can't remember how many months, but I think it was their next 14 months of dividend payments that they're going to owe, which was a big relief for the market, because it is that dynamic around MicroStrategy and the broader digital asset treasury sector which has been really weighing on crypto over the past month or so. Now, part of the reason, getting into digital asset treasury companies, part of the reason that I have been negative, or the main reason I've been negative on crypto over the past 5 weeks, and hence worried about the volatility seeping into the broader market, is the whole digital asset treasury company dynamic. That with all the ETFs and the leverage that is built around that, they are now a multiplier on the way down in the same way they're a multiplier on the way up. So they amplify the moves in both directions. And many of them are turning into a negative kind of death spiral, that as their stock price trades below their crypto holdings, the only logical move is to start selling down their crypto holdings to exacerbate the moves in the downside. Now, most of these companies have kind of chased it and are late to the trade. MicroStrategy is the big one, and it's really important. And that's why their statement yesterday is a big relief. But I still think there's concern around this sector, because more and more people are starting to wake up to the idea that ultimately these companies are probably going to have to start selling down their crypto holdings rather than just accumulating forever more.
And Mark, that was part of the risk-off mood that we've seen over the last 24 hours, but arguably it went a little further. Have you given up on stocks this side of Christmas? Is that your stance on equities as we go towards the end of the year, Mark?
Yeah, I think, look, the backdrop here is still quite positive for stocks in terms of that you've got a lot of liquidity in the system. You've still got companies making a lot of money. We're still in the inflation stage of the AI capex bubble, which means money's being thrown about. The really profitable major companies in the world are throwing that money into other parts of the kind of stock cycle, stock sectors, and therefore that's positive. You also got growth holding up okay, and you've got the US administration pressurizing the Fed to have easier monetary policy than orthodox economics would suggest. Everything is constructed for the stocks rally to continue globally into the year end. Now, I'm more bullish the rest of the world than the US, but I think the US as well will make fresh records next year. Now, because of that view, people start getting at this time of year doing their year-ahead outlooks and getting very enthusiastic to kind of get on board the bullish train now. We know the seasonals are generally good. People chase year-end trades. They talk about the Santa rally. There's this idea that this is the time to kind of position. If you think we're going to make fresh records, why would you not get bullish now? I am more worried about that. I think that we're probably going to get a hawkish cut from the Fed next week, which is going to be problematic in the margin. And I think that the crypto sector is going to have more and more downside, and that's going to hurt the retail sector when we've already got a K-shaped economy pressuring through the cost of living and rising unemployment at the lower end of the income spectrum. I think that's going to pressure investor sentiment across the spectrum, which is going to add to volatility and make it harder in the short term.
Santa might not be coming. That is the conclusion of all of that. Bloomberg Markets Live Executive Editor Mark Cudmore, thank you very much indeed. You can also follow Mark and the rest of the team. Fantastic coverage. MLIV Go on your Bloomberg terminal. Yesterday, we went to Chloe Melly with a very nice picture of an A320. We are now going back to Chloe Melly with another picture of an A320. I think it's an A321. Chloe, over to you.
Good morning, Guy. Yeah, Airbus continues to be the bigger story of the day after some back-to-back problems for that company. We, of course, had the software glitch that caused disruption over the weekend, but then we also had news of some quality issues from fuselage panels. So all of that has been really weighing on that stock. We can see that major dip that we had yesterday, and that weakness could continue today as the market digests those issues. And the founder of AirAsia, which is one of Airbus's biggest customers, has said that testing protocols need to be re-examined and that the pressures of competition, of really ambitious delivery targets, potentially cause some of those quality issues. So that's a story to keep an eye on moving forward as well. Moving on to Bayer, which could be getting a boost today after the Trump administration urged the US Supreme Court to take up Bayer's appeal related to lawsuits against its Roundup weed killer, which is a product that has been accused of causing cancer. It's an ongoing legal battle that's really weighed on the stock over the last few years. And so this is seen as a win, and we could therefore be seeing that stock moving higher this morning at the open. And finally, let's go over to hotels. SABIC has been downgraded by Morgan Stanley. The analysts have said that the acquisition of Delata's hotel operations exposes it to changes in business rates that were announced in the budget budget last week, and this is something really across the hotel sector to keep an eye on, with Whitbread, for example, last week getting downgraded by Bernstein because of the major hit to profit from those changes in business rates. So going forward, we should be keeping an eye on all of those names across that hotel sector as the market digests that profit impact from those tax changes.
Chloe, thank you. Chloe Melly, our equities reporter. And Chloe's right to mention Bayer. We could see quite a pop in the share price at Bayer, it seems, as a result of some of this commentary from the Trump administration. Rothschild and Co. saying this is a solid step forward for the business, so we'll see whether this has an impact at the start of trade. But overall, it's a quieter day. In terms of the overall market expectations.
Big move in Airbus yesterday. Be interesting to see whether it bounces today or whether it stays down. The UK bank story is going to be fascinating too. Do we see any movement around what we've just heard from the Bank of England in terms of capital kind of ratios? It looks like there is going to be some improvement, maybe aligning with maybe what we see in the rest of the world. Does that mean more dividends? Does that mean a better lending story? What does it mean? We're going to find out, I suspect.
Yes, absolutely. And some of these banks in the UK coming forward with some sort of holding statements in the interim, suggesting they're just going to be doing some work on what this capital review, what it means, what the implications are for their balance sheets, and therefore what they're then more able to do. So the banking story in focus, Airbus in focus, Bayer in focus. US futures looking flat to negative, a little more negative than half an hour ago, but not by a huge amount.
Where is the catalyst? Is it coming from crypto? If crypto stabilises today, do you see therefore more stabilisation in the US future story? What are volumes looking like at the moment? We'll see in a little while, but volumes in Europe have been very quiet recently and very low. Therefore, the potential for movement is actually there.
Yes.
And maybe stocks moving in different directions, maybe not offsetting each other. Anyway, that's the futures picture right now. We are looking at a mildly positive open. We'll find out in a moment what the details are. This is Bloomberg. Tuesday morning, good morning. Monday was a bit odd. So let's kind of start there and work our way forward into today's session. Lots of volatility in the bond market. Did it start in Japan? Certainly bled through into the Treasury market. That was reflected on what we saw in the equity market over in the United States as well. You obviously had the crypto turbulence as well to fold into this narrative. This is where Europe went out. This is the US session yesterday. So we rally. It's not a huge rally, but it's a rally, and then basically fold towards the end of the session and finish near session lows, actually. So not too far off. So Europe's got a little bit of a drag maybe coming into today from what we saw in the session yesterday. We went out here, finished down there. But a reasonably mixed picture in terms of what we are seeing. Euro Stoxx 50 futures up by 0.2%. The FTSE's absolutely flat. The DAX is up by 0.2% as well. It is ex-dividend day in France, so just be aware of that. There's a lot of big names, XDs, going through in the CAC 40 this morning. LVMH is the one that obviously stands out, but there's plenty of other big names there as well. So just bear that in mind when you're looking at single stock stories out of France. So watch out for that one. Anna, single stocks?
Yes, just on that, LVMH, you're right, and Thales as well. So we're increasingly focused on defence names, aren't we? So I'll just mention that. Also ex-dividend. Let's talk about some of the other stocks in focus then. Airbus, certainly one of those. Yesterday it was all about what Sun does to data on board aircraft. Today it's about fuselage panels. Airbus revealing a quality issue with some fuselage panels. What does this mean for their delivery schedule? Does the market think it oversold this yesterday? Where will the stock go on day two of that particular story? Bayer also in focus. Some better mood music coming around some of their legal battles over in the United States. And we'll keep an eye on UK banks after we saw the Bank of England cut its estimate of how much capital the banking sector needs for the first time in a decade, Guy.
OK, here we go. Time for the market open this Tuesday morning. Quiet session expected, but single stock volatility could still be there. So let's talk about the indexes and then we'll work our way through this market. The FTSE 100, in some ways more stable, maybe more looking at other aspects of what we're seeing, particularly around some of the metals trades and what we're seeing in some of the commodities markets more broadly. But a flat session, a flat opening for the FTSE 100. We'll wait and see what the CAC does today. I'm interested to see there's a dividend story which we need to fold in, but I'm interested to see what happens with the Airbus narrative this morning. As Anna says, was there an oversold overselling situation yesterday on the back of this concern around what we're seeing with these panels. The IBEX is up by 0.3%, the big outperformer this year, maybe continuing that trend into year end. I'm not expecting the DAX or the SMI to open quickly this morning. There's a bit of news to fold into both of those trades. Bayer, maybe one of the stories we're going to watch in the German market. So I'll hand things back over to Anna for some single stocks and sectors.
Yes, let's have a look at those sectors then first off, Guy. And it seems that the energy sector is not doing too badly this morning. We have not got oil prices going higher, so that's an interesting one, but it's not up by much. Utilities actually now the best performing sector in Europe, and perhaps that tells you a fairly sleepy story about where we are in today's narrative. So we've got some of the energy producers here in Europe. I say sleepy, but energy is increasingly important in this AI world we now live in, isn't it? Autos and auto parts is the worst performing sector this morning, so that sector down around 0.4%. Actually, healthcare now the worst. You've got healthcare at the bottom, utilities at the top. So we seem to be talking a lot about defensives today. If I look at the individual names, and Guy, you were mentioning some of these just now. In fact, we were both talking about Airbus earlier on. That stock is down by just 0.2%, which, given the drop we saw at times yesterday, is probably seen as a little bit of respite. Bayer has not yet opened, so we'll get to that one when it does. And some of the banks look okay this morning. I'm looking at Lloyds Banking Group, for example, up just 0.1%. It put out a holding statement earlier saying it'll be looking at what the details of the news from the Bank of England, what that means for the business.
So what I am seeing, and I'm slightly wary of drawing this conclusion, is that UK house builders are bouncing back today, which makes me wonder whether or not, and these connections may not exist in reality. Are we looking at a situation where the UK banks' capital ratios are improving, which means they can potentially lend more into the mortgage market, which is better news for the house builders? Maybe. But you've got Taylor Wimpey up by 3%. You've got Persimmon up by 2%. So in terms of the percentage gainers, UK house builders are well represented at the top of the board this morning.
Yes, and in the Bank of England's statement earlier on, it was saying that banks should have greater certainty and confidence in using their capital resources to lend to UK households and businesses. So, you know, that's the FPC's expectation, that part of the Bank of England.
Lend more.
Is hoping that that's indeed what happens. Let us talk about these markets and where we are. Sharon Bell joins us, Goldman Sachs Senior European Equity Strategist. And Sharon, very nice to have you with us. Thank you for coming in. I mean, 3 minutes into a session that looks a little bit directionless this morning, so maybe we won't dwell on today too much and think about the bigger picture. How are you looking ahead to 2026 then, given what we've seen from the MAC 7 this year, what we've seen from European stocks this year?
Absolutely. I mean, the MAC 7 has generally performed well, although more mixed recently. Some doing well, some not so much. But Europe has generally done very well this year. Most of it confined to the first quarter, where you had an extremely strong rally. But generally, and particularly if you look in dollar terms across Europe, we've had indices do extremely well, especially those with a lot of exposure to banks. FTSE 100, IBEX, MIB, the FTSE MIB, the Italian index, all done very well because they're heavy in financials and they've really rallied this year.
And so banks have been an area of brightness for Europe. For reasons that we all understand, defence stocks have done OK this year as well. And is that something that we are going to be increasingly focused on? Or do you think the market is going to get more discerning, rotations within the defence sector, a focus on margins? We heard different views.
Yes. So the defence stocks rallied. I mean, they're up about 4 times since Russia invaded Ukraine. And earlier this year, certainly until the summer, they performed extremely well. But in the last few months, they have come off a bit. And I do get a lot of questions from clients about this. They look expensive, so they're just pure PE valuation ratios are very, very high. But if you adjust for the fact that they're going to grow very fast in the next few years, definitely the demand is there. Europe is quite committed to upping its defence spend as a share of GDP. We still like the medium term, but we don't deny that there could be a bit more volatility just because of the valuations.
The biggest decision, it feels, I've had to make this year is currencies. The S&P in euros has done 3.25%. Europe's wiped the floor with that.
Yeah.
If I got my currency call right, nothing else really seems to have mattered. Is there some truth to that? And is that a trade that's going to carry on?
Look, it's been 10, 15 years where we had the dollar appreciating very, very consistently until this year.
Yep.
So it would have been a very punchy call at the beginning of this year. to say, actually, the dollar can depreciate in this environment. We think the dollar can still actually depreciate in 2026 against most countries, currencies globally. We think probably more against Asian currencies rather than against European currencies. But nonetheless...
So I can repeat the trick in Asia next year,
yeah, maybe a bit. Look, I think the dollar still looks very high in our view, still looks a little bit overvalued on a trade-weighted basis. We've got the Fed cutting rates, obviously in the upcoming meeting, but also twice more next year. We have a little bit more questioning about whether you want all this exposure to the dollar, to the big cap US stocks, so concentrated in the index and so highly valued. We just think people are diversifying portfolios, and that is a little bit of downward pressure on the dollar.
OK, let's come to that diversification question. I'm reading so much at the moment about the idea that if you don't want to be in the Mag 7, if you don't want to have all this AI risk, there are loads and loads and loads of really cheap value stocks out there that represent maybe a place to hide. And the valuations, the case on valuations is certainly, it looks about right. The problem is, though, that it's looked right for quite a while, and I'm wondering why now is the right moment maybe to make that trade. And I'm also wondering, is this an absolute trade or a relative trade?
Yeah, it's all good questions. I think when it comes to the Mag 7, a lot of the clients that I speak to, they want to diversify because they know that these companies, they're huge, they've done extremely well already, their valuations are high, and there are risks around them. It's not that some of them will likely be the big winners, but you do not want all your eggs in that one basket, definitely. I think the pushback I get is that there aren't that many places that they can see that there is super value, largely because things like Europe have performed well this year. On relatively little earnings growth. That's the other thing. We haven't really seen the earnings growth for Europe this year. Earnings revisions have generally been downwards. So the valuation for Europe has just moved up, more so in Europe this year than you have in the US. So, yes, I do still think Europe is good value versus the US, and you can find value opportunities. Banks, I would argue, is still one. Maybe there are pockets of defence, etc., as we were just discussing. But I think it's... that valuation gap has narrowed a little bit.
And let me ask you about quality stocks then, because, maybe value stocks have been lifted a little bit by the banking sector, but quality names in Europe then, Sharon, is that an area you focus on for next year? Or are you concerned that maybe they're too defensive, too dollar exposed?
Yes.
Dollar call is...
I mean, this is a very common question we're getting at the moment, and I think it's related to a few things. Key being, at this time of year, everyone is looking at performance year to date and saying, well, which areas have lagged, who's been behind, and therefore who could potentially catch up where I might want to grab a little bit of that. Quality stocks in Europe and actually on both sides of the Atlantic have generally underperformed this year. And in a way, that sounds unusual, doesn't it? You normally want to have quality, don't you? And I think for 15 or 20 years, certainly since the financial crisis, quality stocks generally did extremely well. They underperformed this year in favour of value and cyclicals and things like banks. I think that an element, definitely, they've got better value now. Quality stocks were an enormous premium. That's come down a little bit. But they are dependent, I think, on two things. China doing a little bit better economically through this next year. And really, these are all dollar earners. So if the dollar does continue to come down, then a lot of the quality stocks will be hit by that. So we will be more mixed on a rotation to quality.
So they're more global names. There might be a few of those businesses on the UK markets. UK stocks post-budget, then, Sharon, what's been the reading through a stock market lens? I mean, we saw some of those interest rate sensitive ones getting a bit of a boost as a result of expectations, maybe, that rates come down. But I wonder if that's something you see as long-lasting.
So I do think that there was stock market relief around the budget, more the sense that, yes, it was a budget which you saw extra spending and higher taxes, but not actually more than expected going in, which I think is key. Also, the gilt market reaction was good. And that's extremely important for equities. As you say, a lot of them are quite rate sensitive. There is a big risk premium, I think, still in UK bond markets. And just taking a little bit of that risk premium out helped UK domestic-facing companies. We see home builders do quite well today. Home builders are actually up. Well, they were when I looked yesterday. They've up even more now, 9% since the middle of November. So, and they are a super cyclical UK domestic area. So, yes, I think equities took it relatively well. The other final thing to mention about UK domestic-basing companies is they are probably the value pocket that we've just been talking about. They are inexpensive. So a lot of global investors speak to me about, well, can I find value there? I think you can, but you have to be a bit careful because, of course, there are a lot of risk around the UK economy too.
What would be a realistic number for Europe to deliver next year in terms of performance? You talked about the kind of the earnings expectation. What do you think is what should I be expecting next year?
I mean, 5-6% returns in price, and then you also get for Europe 3 or 4% dividend, remember.
Yep.
So that's actually not a bad total return, and that would be in euros, and we think the dollar comes down again.
Yep.
So if you're a dollar investor, that could easily edge into the double digits. It's not actually too bad, and most of that performance, in my view, next year will be driven by earnings. We think 5 or 6% earnings growth next year, which will certainly be better than the 0 we've had this year.
Great to see you.
Thank you.
Sharon, thank you very much indeed for joining us. Sharon Bell, Goldman Sachs, Senior European Equity Strategist. Core 6 looks like this. This is the picture this morning that we are watching. Defence stocks firmly in focus and are up. Nestlé rising a little bit. I saw a note somewhere talking about the fact that it might sell off part of its coffee portfolio, but I need to come back and double check that. Schneider's up a little bit. Elsewhere, it's a mixed story actually for the chips versus Schneider, so that's kind of, we often talk about those in the same breath. LVMH is ex-dividend. Novo Nordisk is down a little bit. In fact, you're seeing a little bit of turbulence, volatility within the pharma space this morning. Where we are certainly seeing some volatility. Is it the pharma space, is the chemical? I don't know. You can't kind of narrow buyer down, but you're certainly getting some big moves, and that's where Chloe Melly is starting right now.
And good morning, Guy. Yeah, we are seeing some very impressive movements in Bayer this morning, which is up almost 15% after getting a big win in its ongoing legal battles over in the US. So the Trump administration has urged the US Supreme Court to take up Bayer's appeal related to its Roundup litigation, Roundup being the weed killer that has been accused of causing a cancer. And so this is seen as quite a big win for Bayer, and we can see that reflected in those shares today, and we're up very impressively this morning. Moving on to UK home builders, which are also moving higher, and we have got a wall of green there this morning with Persimmon, Taylor Wimpey and British Land as well, because nationwide data has showed that UK house prices rose for the 3rd consecutive month, and so this shows that there was actually quite a lot of resilience in that housing market in the run-up to the budget, which is not necessarily what had been expected, and therefore we are seeing this positive movement here across that house building sector. Moving on to FDJ, which is down this morning after being double downgraded by JP Morgan and placed on negative catalyst watch ahead of the results. So this is a name in the gambling sector that's not as preferred as Entain and Flutter, and is unlikely to see much growth in 2026 according to the analysts, and therefore we are down about 3.5% this morning. And finally, let's end with Campari, and the April maker is up after being upgraded by Barclays to a buy rating, and we're up quite strongly this morning. We're up 3% for Campari.
Chloe, thank you. Chloe Melly with an update on those stocks on the move. Coming up, more safety fears then for Airbus. The latest on their A320 issues. That's coming up next. This is Bloomberg.
Welcome back. You're watching the opening trade. We are 16 minutes into the session, and this is what the picture looks like. Fairly quiet when it comes to the index story, but below the surface there is some significant movement today. Bayer is one stock that we've been watching. Today it's Bayer. Yesterday it was Airbus. Airbus moving massively yesterday, as you can see by this two-day chart. Big dip lower. We did kind of buy that dip a little bit coming in towards the end of the session, but there's not exactly a big bounce coming through this morning. The playmaker revealing that inspections are needed for hundreds of its best-selling 320 family of jets over potential flaws in the aircraft body, i.e. one of the body panels towards the front of the aircraft. There was a briefing last week with customers, and the news kind of came out yesterday. Benedict Campbell, who leads our coverage of this sector, joining us now. So, Benny, let's talk about kind of how this has unfolded. There was a briefing last week. There was a document released. That has now been released, kind of come out and become clear to the world what is happening, and you get a big stock market reaction. Just kind of how significant is this as a risk kind of to the flying public, to the airlines, in relation to the big move we saw yesterday in terms of the stock price? Can you just kind of, how significant is this?
Well, I wish I could say it all sort of came out. The truth is it all trickled out over the last couple of days. Yes, there was a briefing last week, but that has not been publicly disclosed. Airbus is staying quite mum about the whole thing. So, and that might explain some of the nervousness that you see in the market, in the stock price and generally with investors who had looked at this stock very favorably until yesterday. It was up until yesterday about more than 30% for the year. So people are nervous about this, not just the actual issue, but also the way that the company is handling this. Not very transparent, it has to be said. And this comes off the back of the software issue that they had over the weekend. So it was a sort of a 1-2 punch here. On the actual issue, so we're talking about panels that are at the front of the fuselage of the A320 aircraft that are not sort of meeting specifications. We're talking sort of millimeters here. This is not a great misalignment, but enough to be noticeable. So what Airbus is doing now is going through literally hundreds of aircraft, some of them already in service, some of them sort of at some stage of production, to check where things are at in terms of the panel specifications. Are they out of spec? Are they within? When might they need to be fixed, and so on? And that's sort of where we stand. A very arduous, complicated process.
Benny, we appear to have two problems, though. You've got the problem with the aircraft, and you've got the problem communicating the issues that are being dealt with here. That was a really big move yesterday. And it's the relationship between the issues surrounding the aircraft and the move in the share price that I'm wondering about. Is there just not enough information at this stage to be able to make an accurate assessment of the problem that Airbus faces with this? So are we compounding the initial problem with a communication problem that the market just doesn't have the answers and therefore is overreacting?
Well, there is a bit of an overreaction, partly because the bad news so far had always been on Boeing, really, and Airbus had fairly smooth sailing. Yes, they had issues with their engines, but this all seemed sort of manageable. Don't forget also that we are sort of in the last weeks of the year, and this is where everything has to really fall into place for Airbus if they want to meet their full year delivery target. So anything that sort of upends that and upsets that makes people additionally nervous. We don't know at this point just how disruptive this latest finding might be. Airbus says that they expect most of the panels to be within spec, so it might, a little bit like the software issue that we had over the weekend, which sort of flared up and then disappeared again very quickly. This might be similar here, but it sort of adds to a general sense of nervousness, which is, does Airbus and does the aviation industry at large have its products under control? Is there a risk that potentially they are putting speed above care? Is there a risk that as they increase the numbers of planes that they churn out, they are cutting corners, or that suppliers are cutting corners? That would sort of be the hard way of looking at it. The more charitable way, which surely Airbus would see, would be the system works. We noticed something that was wrong, we alerted the public, we alerted customers, and we are dealing with it. So sort of two schools of thought here, but either way, there is a problem, and the market is nervous about it.
Yes, and Betty, I guess it does matter, doesn't it, whether it was a quality control process that caught these things before they left the factory, or it's aircraft that are currently flying, and the sort of getting a handle on how many aircraft fall into both of those camps would seem important.
Yeah, of these aircraft that need the inspections, the vast majority are still somewhere in the production process, but about 160 of them potentially have this panel issue. Again, this is not a safety issue as such that needs immediate attention. If you compare it to the software issue, the regulator said, you need to fix this before the next flight. That's not the case here, so they can sort of inspect the planes, then realize whether there's a problem or not, and if they do find a problem, they can sort of take care of it over time. So they can then sort of talk to the customer at some point and say, bring the plane in at some point and fix it. So they didn't say this needs immediate attention. So they've won themselves a little bit of time. But again, it doesn't sort of instill confidence by the flying public in the product necessarily, even though Airbus says it's safe to fly.
Benny, thank you very much. Bloomberg's Managing Editor for Space and Aviation, Benedict Kamel, joining us there from Germany. Let us quickly pivot to what's going on in the UK and the banking sector and the knock-on impact that the banking sector and decisions around it is having on some of the house builders today. We see house builders are moving higher in this morning's session. Persimmon, Taylor Wimpey, for example. Is there a link with the Bank of England story? We will consider that. The BOE said all of the UK's 7 largest lenders passed its latest stress tests, which examined their resilience resilience to an economic shock. The firms could have enough capital to continue lending through strains to the economy, according to the results. Bloomberg Global Finance reporter Laura Noonan is here with analysis. Good morning to you, Laura. We heard a lot from the Bank of England this morning across a whole load of asset classes. Your focus then has been on the capital buffers and the Bank of England cutting those capital buffers for the first time in quite a long time as the sector shows some resilience. So what's your big takeaway?
So this has been a really exciting day for those of us interested in UK financial regulation. What the Bank of England has said is that back in 2015, they said banks needed a certain level of capital across the system. That was 14%. They now believe that is 13%. That is quite a big difference. Now, we're not going to see that flow through until 2027, but it is still theoretically reducing a lot of capital back into the economy, which banks can use, they say, for lending, possibly payouts. So it is a significant day for that. And part of the reason they're doing it is, as you said, nobody failed the UK banking stress tests. Everybody's fine. Now, nobody has failed a stress test since 2016. So that in itself is not unexpected. The other thing, which is obviously happening right across UK, is that there's a lot of pressure to support growth. There's a lot of pressure for the Bank of England to consider the competitiveness of the UK finance industry. And that is partly what is leading this review. So what they're going to do now is have a review as well and look at a few tailored areas where they might be able to make regulation better, and they'll do that early next year.
At the same time, we're lowering capital standards at the same time as flagging risks.
Yes.
So let's talk about the risks. Where do they see the risks? Because there seem to be multiple pockets of risks that they're worried about at the moment.
It is a delicate balancing act, and they do see a lot of risks. I mean, AI was called out again as an area of risk, and they are concerned about bubbles there. They're concerned about valuations. They're concerned about private markets. Later in the week, they will launch a new private market stress test. So there's a lot of risks. And I think the Bank of England is in a dangerous situation where they're trying to give the minimum amount that they can give while still being seen to give something. I think that is the game they're in. And we'll have a press conference later today where we'll be pushing them on, well, if you're lowering the neutral level of capital, is that not deregulation? Because they've been saying all along, we are not deregulating, we are simplifying, we're calling it everything but deregulation. But if you actually lower the number, because the number matters, there's been a lot of other action around, bankers' bonuses, all of that. That's fine. But what really matters is the amount of capital in the system. And that is what they have now signalled that they will lower, albeit not until 2027.
Does this not bring them into line with others, does it?
They would argue that it does. They have a new paper out today among the many, many hundreds of pages this morning, which shows that the UK, having done this, will be in line with where international neighbours are or where they are headed. That's a bit of a fine-tuning as well, because both the US and the EU, which are the relevant international neighbours, are both making changes. We don't quite know where they're headed. We suspect they're headed to a lower place. The other final thing I'd say on that is that while the current level of requirements is 14%, banks actually hold 17%. So banks never trust that they can run at the level. And it's going to be quite difficult, I think, to convince banks that they can actually take this money out. And that's part of the challenge. There's been a lot of debate around buffers and how much you need to maintain these buffers. And the idea is the Bank of England wants to give the banks confidence that if the requirement is 14 or if it's 13, you can hold something closer to that. And that's going to be a whole conversation.
What time's the press conference?
The press conference is at 10.
Excellent. We're going to be tuning in. Laura Noonan, thank you very much indeed. The Markets Today team hosting a live Q&A, 1 p.m. today on all of this. Digital subscribers, terminal clients have the exclusive opportunity to ask questions around what is happening here. Up next, we'll get back to the market story. That's next. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes into a session that's a little bit quieter than yesterday. Yesterday's mood was pretty risk-off. Was that driven by higher yields in bond markets, the cryptocurrency sell-off? All of that continued into the US session of yesterday, Guy. But here in Europe, then, maybe drawing a bit of a line in the sand, and European equity markets going a touch higher. Certainly that's the case over in Germany. Maybe that has too much to do with one particular stock and buyer in focus there. But the DAX is up by 0.4%. Yeah. Some ex-dividends coming through in the French market, so we're a little flatter in that one. The UK market not in a hurry to go anywhere. But the overall picture created by these markets is one that's much more typical of maybe the quieter months of the year, and maybe we're heading into one of those.
Yeah, I think you back buyer out of the DAX, and it looks fairly flat as well. And you could see it. You look at the internals this morning. Higher, 274, lower, 307. We are fairly balanced in terms of what we're seeing. So you're not seeing a lot of volatility, a lot of cancelling out happening in terms of the volatility picture. Volume is reasonably light, as you would normally expect at this time of year. So the internals not really telling you a huge story this morning. You get into single stocks, though, life gets significantly more exciting. Bayer is the one that really stands out this morning. The commentary coming through from the Trump team, maybe pushing the US judicial system, maybe to have another look at the Roundup story. Bayer reacting really positively to that. We're up by around 12%. That's giving a decent lift to the German market this morning, as is as well Siemens Energy. That is up by 2.27%. Banco Santander is up by 1.1%. Is that a UK story? Remember, this is a big UK lender as well. Think about it as a UK bank, not just as a Spanish bank too. So that's the picture on the upside. Let's talk about the downside. There's a fair pharma sort of theme running through this. Novo's down by 1.4, Astra's down by 0.7%. That's a big factor for the London market. LVMH is ex-dividend today, so just be aware of that. There's a whole load of French XD stocks today. A lot centred in the luxury sector, but you've got names like Thales as well, also going XD. LVMH down by 0.9%, Anna.
Let's focus in on some of the other stories that we need to keep on our radar this morning then, Guy. The Bank of England has cut its estimate of how much capital the UK's banking sector needs for the first time in a decade. The BOE also signalled a consultation that could free up extra lending and higher payouts to shareholders. Bloomberg has learned Warner Brothers has received a mostly cash offer from Netflix as it fields a second round of bids. Sources say the offers are binding, which means the board can sign off on a deal quickly if its goals are met. Warner Brothers is said to want $30 per share. The stock closed at $23.87 on Monday in New York, giving the company an equity market value of $59 billion. Bitcoin is steadying after almost $1 billion of leveraged crypto positions were liquidated during another sharp drop in prices yesterday. Traders are watching $80,000 on Bitcoin as the next key support level, with the market expecting structural headwinds to continue for the rest of this month. Guy.
OK, let's move back to the markets and figure out what we are anticipating for next year. We're very much coming to the conclusion of this year. Ashmore Group predicts 2026 will be a year of deflationary shocks, some of that coming from AI, but actually in some ways underpinning the markets, more of a Goldilocks theme returning as well. Ashmore's research head, Gustavo Medeiros, joining us now for more on their EM and global outlook. Good morning.
Good morning, Guy.
Deflationary shocks coming next year. Is that the big theme that I'm going to be thinking about? How do I think about 2026? What's the kind of the big overarching thought that you have about it?
Yes, absolutely. It's this time of the year to take a step back to look at what kind of can happen in the next 12 months. 2025 was the year about U.S. policy, right? We've seen tariffs coming and going. We've seen the budget that put a lot of incentives for CapEx, and the big tech companies are going to benefit significantly from that. We've also seen a very erratic policy, which now we're closing the year with a discussion about the regime change at the Fed, right? This sets the scene for 2026, which is going to be mostly about the business cycle. And we think, too, that the impact of AI on global macro is going to be very important to monitor. Against that backdrop, you have China exporting deflation for the rest of the world. And in our view, when you think about AI, if you look into the company results, if you look into kind of what broader companies are adopting, what they're doing, it seems to be quite deflationary before being inflationary, i.e. Layoffs on the labor market is probably going to impact the global macro picture first before we hit the boundaries in terms of energy availability, in terms of capital availability, etc. Therefore, we think that at least the first half of 2026 is one where you have more disinflationary forces, and that's very much against the consensus, Guy, where we've been talking a lot about debasement recently. And I think that the hawks and the debasement, people that are worried about debasement, too much inflation, are right over the last 5 years, but on a forward-looking basis, that can change.
The picture you're painting is one in which the Fed will be able to cut. Correct. And cut reasonably aggressively. Do other central banks cut? Because they've already, if you look at the ECB, for instance, already lowered rates quite significantly. Other central banks have lowered rates quite significantly as well. Basically, what I'm getting at, are we going to see a cheaper dollar next year? And is that going to be the overarching theme that drives my investment decisions going into next year? This year, it's had a really big impact in terms of portfolio performance. Is a cheaper dollar going to be the theme of next year? And how do you see it manifesting itself?
I think it's going to be part of it for sure, because if you look in G7, the central banks that have room to cut rates are the Fed and the Bank of England. And I think that if we do have an appointment of Kevin Hassett to the Fed, we know that this is going to be more progressive thinking Federal Reserve, right? They want to think on a forward-looking basis, and the market might have its questions around that. But going, again, 2025 was the first year where we've seen the dollar weakening on the back of a risk-off market, on the back of kind of like a 20% correction on the S&P. That changed dynamics. That started to change asset allocations because of the change in the correlations of these asset prices, right? And we think that going into 2026 is just going to be a continuation of this trend. I think that the really kind of like the year that marked the started of the dollar weakness was really 2025. But I think that we're going to see ongoing dollar weakness as the Fed potentially cuts policy rates more than people expect. Against this backdrop, you think about very quickly in emerging markets, there is a number of emerging market central banks from Brazil to South Africa to Turkey, including in the frontier space, that have been actually keeping a very hawkish stance, and real interest rates are at the highest levels in 15 to 20 years. And that is, I think, the biggest development. As these disinflationary shocks keep on getting to the global economy, these central banks will have a lot more room to ease without an impact on their currency because of the weaker dollar backdrop.
Okay, and Gustavo, it is the weakness of the dollar. You focus on global macro, but as it applies to emerging markets, don't you? And it's
Absolutely.
The weakness in the dollar and the path for the dollar that really does make a difference for those emerging markets. So you see that continuing. Is this a structural change in the dollar that emerging markets can count on in the future, or is it just cyclical?
I think it's cyclical, but the cyclical picture is a 10-year picture. The dollar peaked in nominal terms in Q4 2022 at 114.80. In real terms, it peaked just recently after Trump got elected because inflation differentials. And we've seen actually the typical peak to trough cycles in the dollar are 8 to 12 years apart. And now we have a very large amount of global investors that are over-allocated to U.S. capital markets and a U.S. administration that wants a weaker dollar. So that really rhymes with the prior two peaks that we've seen, which was 2001 and 1985, when we had in 2001 far too much over-allocation to U.S. capital markets. In 1985, the U.S. administration wanted a dollar weaker. Today, we have two forces playing at the same time. So we think that we are in a cyclical dollar weakness, but is again at a long-term 10-year cycle, which should reflect asset allocations, which are not there yet. They have too little diversification so far.
And how does that rub up against the AI story? Because you mentioned that it's going to be deflationary to start with. I imagine the United States will be early adopters when it comes to the AI technology, just like they are spreading the AI technology around the world through chips and the like, and hyperscalers. So, I mean, how convinced are you that the deflationary phase, how long will it last for? Is it just a 6-month thing, or is it a few years that we are in this deflationary period before we get the inflation impact that you foresee?
That's a great question, and I think we have to be humble here. We don't know exactly. We need to monitor it on a quarter-to-quarter basis. What we know is new technologies are disinflationary, deflationary, right? These technologies are quite powerful, and we can see in our day-to-day that things are changing a lot. We can see on the company's results, on the technology sector, now it's broadening out to other sectors that companies are already doing more with less, i.e. higher results with lower labor participation. And the forward-looking basis, if you look at surveys, 1 in 4 companies in the UK, if I'm not mistaken, or 1 in 5, are planning to actually have a smaller labor force today. And the risks on the inflationary side are, again, constraints. Think about energy constraints, capital constraints, ships constraints, etc. But most companies so far are actually talking about the excitement of the adoption, and that should be a disinflationary force that kicks in first in 2026 before we actually get. I personally think that if you look at the inflationary force is going to start hitting once we have a much bigger adoption of the technologies that are very data intensive. Think about self-driving cars, kind of like loyalty to the economy, etc. That's being tested so far, but not widely adopted. Once it gets widely adopted, it may be.
So is it deflationary because of what it does to price discovery, or is it deflationary because people are put out of work?
Because people put out work, and central banks have to react to that, right? You have to think about like the 1990s, while Alan Greenspan was basically looking at a picture where growth was surprising to the upside, but inflation was not coming through, and actually you saw the labor market softening, and you have to react to the labor market.
Makes you wonder what happens in China. they've already got deflationary forces. You add this in, it could be quite a mix.
Absolutely, and we'll turn to China in just a moment. Gustavo, thank you very much. Thank you for joining us. Gustavo Medeiros, Head of Research at Ashmore Group. Let us turn to China right now, in fact. China's DeepSeek has unveiled 2 new versions of an experimental AI model, claiming the new service matches the performance of OpenAI's flagship GPT-5. DeepSeek says the new model performs well across multiple reasoning benchmarks, suggesting China's open-source systems remain competitive with Silicon Valley's frontier proprietary models. Analysis by Bloomberg suggests China's top-down AI strategy sets the country up to achieve large-scale deployment that the US will struggle to replicate. The national rollout leverages low-cost open-source models and gives China a greater chance of improving economic productivity. However, this model comes at a cost to private sector tech firms. This is the focus of this new deep dive on the Bloomberg terminal, written by our senior Bloomberg Intelligence China tech analyst, Robert Lee. Robert, so nice to have you with us. Take us to the top of this story, because I just read out a lot of conclusions from your report, and maybe you can take us to the most salient point, the key thing we need to take away here. How big what is the main conclusion then from this report?
Well, I guess the main question is who's the ultimate winner of this, and our conclusion is very clear. It's actually the Chinese economy. This ties in very much with what our colleagues in Bloomberg Economics have been saying, that through the top-down AI strategy, which is referred to as AI Plus, in which the government is trying to accelerate the proliferation of AI across every sector of the economy, across every province within the nation itself, that stands to boost economic productivity. So it's the Chinese nation, it's the economic productivity as a whole that stands to benefit from this. And I'd say arguably China is emerging really with a global lead in the real world deployment of AI. But ultimately, somebody has to be paying for this. So the second question is obviously who is. Now, to some degree, there's a high level of government subsidy, which is funding this rapid rollout. But it's the shareholders of the private sector tech platforms, the shareholders of the likes of Alibaba and Baidu, that are subsidizing it effectively. So again, that is borne out on the data that these companies themselves are reporting. For example, on the AI cloud sector, Alibaba's cloud margins are high single digits. Now that compares to about 37% reported by Amazon Web Services in the US last year. So the level of profitability is significantly low. It's too low to have a transformative effect on the earnings outlook for most of these big listed tech platforms, but it's the Chinese economy and the scope for productivity savings which will ultimately be the main beneficiary.
Can they do it without NVIDIA, I guess is the question. And can they do it without NVIDIA and still deliver the energy? Is there the energy needed to do it without NVIDIA? Just walk us through the impact that NVIDIA is having.
Okay, well, I would say I think most people agree for the time being, and probably the longer term, the door is closed to NVIDIA at the moment. I know there's still a lot of political machinations. It may change from week to week, but I think, you know, that ship has sailed, the horse has bolted, whatever, you know, choose your cliche of your choice. But yeah, the evidence, as you said in your intro, speaks for itself. I mean, DeepSeek has come out with a new iteration on its model, which it is claiming is on par with the latest models from ChatGPT. If you look at third-party benchmarking services, so we often use one called LiveBench, which is actually a US-based benchmarking service, then the performance premium that OpenAI enjoys is only 10 to 11%. So China has achieved, over the Chinese models, I should say. So China's already achieving that with the export restrictions, etc. And as the supply of domestically developed AI accelerator chips from Huawei and others increases, then I still think, you know, that there is going to be a challenge over the next 12 to 18 months. But China's already managing that relatively well. And I think the direction of travel is clear. The other thing, just very briefly, come back to your point of electricity. China is one of the few large nations out there that has continuously invested in its electricity infrastructure network over the last 20 years or so. I mean, some of that is as a necessity with increasing urbanization, etc. But they have a very robust electricity network which is able to deliver and meet the demands demanded by AI. So I think, you know, I think that's another potential source of strategic advantage for the Chinese in this race. Yeah. However, America will still lead in frontier model development.
OK, well, I was going to ask you, I mean, you've talked about large language models then and the race there between ChatGPT and DeepSeek and others. But what about the broader question about who stands the best chance of winning then the global AI race?
Okay, I mean, I'm often asked this question, and it's a very obvious one, but I think, you know, we live in a bifurcated world. China operates in its region. I mean, there are clearly a lot of countries, whether it's in Southeast Asia, Africa, Latin America, that are on friendly terms with Chinese companies and with China itself. So that will lead to export opportunities for Chinese firms to export into those regions. But clearly the door in Western Europe and the States is closed to Chinese technology for all the obvious reasons at the moment. And then equally, America and its allies exist in a separate sphere. So I think, you know, we're in a bifurcated world.
OK. Rob, can I just come back to that issue of if you are not the United States sphere and you're not in the Chinese sphere, which solution do you pick? Because, yeah, you're right, the Chinese have the energy, but not everybody has the energy. And it looks like the Chinese solution requires more power. So if you're a third party, which way do you go? Do you go with the US solution, which doesn't require so much power, but requires, obviously, NVIDIA chips, etc.? Or do you go with the Chinese solution, which requires more power, and you have to deal with that? What does the rest of the world do?
Yeah, you are making me think there. That is a good one. I think for a region like the Gulf, which I suppose is on many of the Gulf countries, Saudi in particular, tries to maintain good relationships with both China and America. But clearly, you know, sunlight is ample. There is scope for them to build out and enhance their solar infrastructure as a source of energy supply. But then if you look like countries like Japan, post-Fukushima, obviously the energy supply is under massive pressure. I think even today you've seen an announcement that they're going to restart some nuclear reactors. I think it's countries like Japan and maybe Korea, you know, who sit in the middle there and do have potential, you know, in a potential bind going forward. I don't think there's any quick and easy solution to them. But maybe the most obvious route for them to go down again is, as the Chinese have done, to move towards smaller, more computationally efficient models which are going to use less power in the first place and try to manage the situation and the constraints that way.
Rob, great stuff. Thank you very much indeed. Rob Lee joining us from Bloomberg Intelligence. Up next, we'll turn our attention back to what is happening with the geopolitical story. President Zelensky is on a visit to Europe and says the latest Ukraine peace plan is, quote, better. All the details next. This is Bloomberg.
Welcome back. This is the opening trade, 8:51 in London, and European stocks overall not moving too far. We've got a big move in buyer over in Germany, and the DAX is up basically on the back of that, so up by around 0.5% on the German market. Elsewhere, flat to positive. US futures are almost entirely flat this hour. Our focus is on many things this week, but one of them is on geopolitics and trying to resolve Russia's war in Ukraine. With that in mind, we know that Steve Witkoff, the envoy from the Trump administration, has made his way to Moscow. And we hear from the TASS Russian news agency, the Kremlin is saying that the Putin-Witkoff meeting is set to take place in around 5 hours' time. So it's just coming up to 9 o'clock here today. So European time, that'll be sort of early to mid-morning.
Yeah.
Afternoon, sorry.
Yeah. And will allow him maybe to kind of be on maybe a more sensible body clock time from his point of view. Let's talk about what defence stocks are doing this morning. We continue to use them in some ways as a litmus test for how the market is feeling about what is happening in Ukraine. A little bit of a bid coming through this morning, nothing really significant, but we have seen some volatility in these stocks. Keep an eye as well, I would argue, in Central and European currencies, because in some ways you could see some pinging around of those if we do get a peace deal. And again, just looking for a kind of an idea, a test of how the market feels about what we are seeing when it comes to this story. Witkoff is, we think, we've now got the timing, we think, going to meet Putin a little bit later on today. He's in Moscow for talks on the latest proposals to end the invasion of Ukraine, or at least provide some sort of a way out of where we are now. Volodymyr Zelensky has said the new version of the peace plan looks better, but the Ukrainian leader is warning that territorial issues remain the most difficult to solve.
And on the topic of security guarantees, we have concrete details from the US, concrete details from Europe. I'd say these are the three main topics, tracks, but also triggers. We need to be very careful here. I thank our negotiation teams. The plan looks better.
Okay, let's go to Warsaw for getting an update on what's happening here. Piotr Skolomowski joins us for that. We are getting a better reaction to the peace proposals that are being put on the table at the moment, Piotr, but what we don't see is a resolution to the territorial issue. If we don't get a resolution to the territorial issue, does the rest of it really matter?
Hi, Guy. Indeed. So we heard, as you just showed, we heard from President Zelensky, who said the plan looks better. Obviously, it does look better because there's input from Ukrainians. The initial 28-point plan had no input from Ukraine. Literally, it was just written together or put together between Steve Witkoff and Kirill Dmitriev, so Russia's representative, and it caught everyone by surprise, pretty much. So, as you said, I mean, territorial issues at this point have been sort of taken out of the initial plan. And as Zelensky pointed out, these are the key issues: territories and security guarantees. Now, and here's the rub, because as a matter of fact, that's the point where both sides differ quite significantly. On the one hand, Russia, and we heard from President Putin last week, who said, well, what's the plan, or what is emerging right now is a good basis for discussions, but we're not going to give up on taking over the land that they don't really control. At the same time, Ukraine is saying this is a red line for Ukraine. They are not going to give up land in the Donetsk region, which Ukraine controls most of, but still hasn't actually taken full control of. So it's hard to imagine that there's going to be some kind of an agreement where both sides could come to the table and, without being forced to it, agree that this is where we sort of pause.
Piotr, we're going to watch these meetings very carefully. We're looking forward to your coverage. Thank you very much indeed. Piotr Skolomowski joining us on the latest as we look to the Dublin trip, we look to the Witkoff trip to maybe see some progress.
Yeah, it does look as if, and you made this point before we went to Piotr there for that update, we're seeing a little bit of movement up in defence stocks, which does suggest perhaps at the margin the market is a little bit less excited about the prospects for peace than they were yesterday, where we saw a drop in defence stocks. But the market, just like everybody else, waiting to see whether some kind of common ground what kind of common ground can be achieved.
Can emerge, and do we get, and then what happens after that? I think there's this sort of huge gap in our understanding.
How sustainable can it be?
Yeah, how sustainable is it? What happens to the European defence story? What happens to Central and Eastern Europe in terms of their currency? There's a lot will happen at that point, potentially, depending on the nature of the deal. That wraps Tuesday up for us. We will, of course, be back tomorrow. It's an interesting week. It started off very strongly today, a little bit quieter. The Pulse is up next. Francine walking you through all of the action. That's next. This is Bloomberg.